This tutorial looks at a common investment ratio called earnings per share. Earnings per share, or EPS for short, is calculated by taking the earnings attributable to ordinary shareholders and dividing it by the number of ordinary shares issued. The earnings attributable to ordinary shareholders is basically your net profit after tax and after the provision for preference dividends. So it's the profit left over to pay your ordinary shareholders. Remember that this profit available to ordinary shareholders can either be paid out as a dividend or it can be retained in the business as retained earnings. Your EPS is thus basically just your ordinary profit divided by the number of shares. So it's your profit per share. Now, a high earnings per share or profit per share is usually considered a good thing because it therefore means that dividends can be paid out. If the company is not making profit, if the earnings per share is low, then that is considered a bad thing because no dividends or no cash flow can stem from the profits of this company. Now, does that mean that a share which has an earnings per share of 50 Rand is better than a share which has got an earnings per share of 25 Rand? Which of these two would you invest in? Well, it depends. You cannot just simply look at the earnings per share and make a determination as to which share is better to invest in. The question is, what is the price that you're paying in order to get this profit per share of 50 Rand and this profit per share of 25 Rand? Let's say in this company that's giving you an earnings per share of 50 Rand, the price for that share is 500 Rand. And the price for the share that's giving you earnings per share of 25 Rand is 50 Rand. What would you now say? Which share would you invest in? In order to make that call, you would need to work out what's known as a price-earnings ratio. So how much are you paying per Rand's worth of earnings in each company? So the price-earnings ratio for the first company is 500 divided by 50. So you are paying a multiple of 10 for every 1 Rand's worth of profit. Whereas in the second situation, the price is 50 Rand, the earnings per share gives you 25 Rand, so you are only paying a multiple of 2 times per Rand's worth of earnings in the second company. So the company that has lower earnings per share of 25 Rand actually represents a better investment, because to get the 25 Rand profit per share, you're only paying double the amount of the profit. Whereas in the first company, in order to get profit per share of 50 Rand, you are paying 10 times that amount of profit in order to buy this share. So this obviously does not represent a good investment in relation to the second company. That being said, however, this is not an exact science. A high price earnings multiple or ratio, like 10 times as we have here, might still indicate a good potential investment. The high price might be based on anticipation of greater profits. So they're not just looking at the profits now, they're looking at the profits in the future of this company if this company has got really amazing prospects. So a judgment call with all information in mind is needed when dealing with such things.